Incentive stock options, they can be an incredible part of your compensation package. But let's be real, when tax time rolls around, they feel more like a puzzle. And it's a puzzle where one wrong move could cost you thousands. So let's solve it together.
You know that feeling when you're granted stock options, or ISOs? It's amazing. It's your company basically saying, we believe in you, and we want you to share in our success. It's a huge vote of confidence. And then, the calendar flips to tax season. All of a sudden, that awesome reward comes with a stack of confusing paperwork and that nagging fear that you're going to make a really expensive mistake.
So let's just frame this the right way. Your stock options are both a reward and a puzzle. Our job right now is to solve that puzzle so you can actually maximize the reward.
Because, and I'm not exaggerating here, getting this wrong is not a small oopsie. We're talking about a single error in how you report your options that can lead directly to you overpaying your taxes by thousands of dollars. Let's make sure that money stays in your pocket, not the IRS's.
To get the taxes right, you first have to understand the journey your options take. It's kind of like a life cycle, so let's walk through it, step by step.
Everything really boils down to 3 key dates. You've got the grant date, that's day 1, when you get the options. Then there's the exercise date. That's when you actually pull the trigger and buy the shares at your locked-in price. And finally, the sale date, when you sell those shares. The amount of time between these dates, it is absolutely critical for your tax bill.
And that time gap brings us to probably the most important term you need to know in the world of ISO taxes, the qualifying disposition. Seriously, this is the gold standard. It's the goal you're aiming for to get the best tax treatment possible. The rules themselves are surprisingly simple, but oh my gosh, the financial impact is huge. To get that best case scenario, the qualifying disposition, you have to meet both of these conditions. You have to hold the shares for more than 1 year after you exercise, and it has to be more than 2 years after they were first granted to you. You do that, you get those sweet lower capital gains tax rates. But if you miss even one of those deadlines, a chunk of your profit gets slammed with the much higher ordinary income tax rates. Big difference.
But wait, there's a plot twist. And this is the one that catches almost everyone by surprise. Just the act of exercising your options and holding on to the stock can trigger something called the Alternative Minimum Tax, or AMT. Let that sink in. You could owe the IRS money even though you haven't sold a single share or seen a dime of cash. It's a really crucial thing to be aware of.
Okay, so you get the timeline now. Let's get down to brass tacks and start decoding the actual tax forms you're going to get in the mail. This is where the theory turns into reality.
You're going to be juggling a few key pieces of paper. Your employer is going to send you a Form 3921. Your broker will send a Form 1099-B, but the MVP, the one you really need to pay attention to, might be a page called Supplemental Information. Oh, and if you end up with one of those disqualifying sales, part of that income will pop up on your regular old W-2 as well. All right, first up, Form 3921. The best way to think about this is like an official receipt from your company to the IRS. It basically says, hey, just so you know, this person exercised some stock options. It's got all the key dates and values. It's the starting point for everything else. Next in the pile is Form 1099-B. This one's from your broker, and it's pretty straightforward. It just reports the sale of your stock to the IRS, how much cash you got when you sold. But, and this is a huge but, the cost information on this form is very often incomplete. And that brings us to your secret weapon, the Supplemental Information Form. Now listen closely. Your broker makes this for you, but they do not send a copy to the IRS. This little document has the corrected, adjusted numbers you absolutely need to make sure you don't overpay your taxes. It is incredibly important. So, now that we've met all the players on the field, let's talk about the game plan. We're going to focus on how to use these forms to sidestep the most common and most expensive tax trap out there. And here it is. The single biggest mistake people make year after year is just blindly trusting the cost basis number on their 1099-B. If you use that number without checking, you could easily end up getting taxed on the same income twice. Double taxation. It's a nightmare. Let's look at the evidence. The form on the left, your 1099-B, usually just shows what you paid out of pocket to exercise. That's your cost, right? Wrong. The form on the right, your supplemental info, shows the adjusted cost basis. That's the real number you need to use, because it correctly includes the income portion you may have already dealt with for tax purposes. I mean, think of it this way. Making this one little adjustment is the difference between paying what you actually owe and accidentally giving the IRS a huge generous tip that you never, ever intended to pay.
Okay, you know the trap. You see it coming, so let's move on to the solution. Let's build a clear, step-by-step game plan for filing your taxes the right way.
The whole process is actually pretty logical when you lay it out. You grab your brokerage forms, the 1099-B, and that all-important supplemental page. You use those to fill out Form 8949, which is where you make that critical cost basis adjustment. Then you carry the totals from there over to Schedule D. And finally, that final number gets plugged into your main tax return, your Form 1040.
And here's what that looks like in the wild. Form 8949 is where you officially report the sale to the IRS. You'll put in the numbers from your 1099-B, but then, in the adjustment column, you'll enter the correction using the data from your supplemental form. This right here, this is the exact moment you stop double taxation in its tracks. Once Form 8949 is all squared away, the totals flow right onto Schedule D. This form is like the grand central station for all your capital gains and losses for the whole year, and it spits out the final number that's going to impact your overall tax bill. And that's it. That's the solution. By understanding the timeline, knowing your forms, and making that one crucial adjustment, you've swapped all that confusion for confidence. You are now totally equipped to navigate your ISO taxes and dodge that nasty trap. So, you've solved the tax reporting puzzle, which is a massive, massive step. But, it opens up an even bigger question. Now that you know the rules of the game, is your actual strategy for when you exercise and when you sell truly lined up with your bigger, long-term financial goals? That's the next level of planning to think about.